In this section, we are talking about the initial valuation of accounts receivable. And accounts receivables are generally from credit sales. Since it is sale, so it indicates the company will recognize revenue. The reason is the company has performed its obligations by delivering goods or provide service. So the revenue should be recognized. The company provides credit to its customer, so the customer can make the payments later. Depends on the agreement. So instead of recognizing cash as an asset, the company recorded receivable instead. This is very common in the real business world. Many companies provide credit to their customers, especially for the B2B transactions, business to business transactions. Accounts receivables are informal credit arrangements supported by an invoice and usually are due in 1 or 2 months after sales. This short-term credit usually can increase the sales. That's one of the reasons why the business provides credit to their customers. Since the receivables are due within 60 days, they are generally classified as current assets. But in some cases, the receivable can also be classified non-current assets because the receivable could be due more than 1 year. The journal entry for a credit sales is for a company recognize accounts receivable as an asset and also recognize revenue at the same time. Debit and credit, this is amount to be recorded. The sellers recognize the revenue equals to the amount of receivables or the amount they are entitled to receive. Most receivables could be collected within 1 or 2 months. So usually we do not account for the time value of money because the time value of money is very small, immaterial. But for receivables that last longer, for example, over 1 year, we may account for the time value of money. There are also other considerations for different circumstances. The cash sale is very straightforward. Basically, the company will debit cash and recognize revenue. And this debit cash also represents the other party, the customer, has fulfilled its responsibility by making payments, and this transaction is not. But for the credit sales, only the business, the seller side, satisfied its obligation, while the customer has not. For sales, actually, the seller provides different discount, and in accounting, we should treat the discount differently. So there are 2 discounts. One is trade discount. The financial accounting does not account for the trade discount. Basically, it's the discount to the sales price or list price. The financial accounting only accounts for the price after discount. For example, the list price of a product is $100, and if the seller offers 20% off, the actual price is $80. So if the product is sold, the company should recognize $80 sales revenue. The $20 discount will not be recorded. That's the discount we are all familiar with as a customer. For example, buy one, get one free, buy one, get the second one 50% off. So these are all trade discount. So for financial reporting, this discount will not be recorded in the accounting information system, or we do not make journal entries to record this discount. The trade discount is a discount before sales. The purpose of this discount is to increase sales. By reducing the price provided discount, the sales will increase. Sales discount is different. This discount is offered after sales, especially for the credit sales. Since for credit sales, the business will record accounts receivable and sales revenue. This discount actually is to promote clients to make the payments early. So sales discount is only available to the credit sale customer. It provides incentive for early payment. This provision will be available in the invoice. So here, this 210 net 30, that's how you read it. 210 means if the customer makes the payments within 10 days after sales, the customer can have a 2% discount. Otherwise, the due date is 30 days after the sales. Financial accounting account for this discount. There are also two different methods for the sales discount. First is gross methods. Gross methods basically assume the customer do not take the discount. So the credit sale in this example, total amount is $20,000. If the customer makes the payment, assume the customer make payments within 10 days, there will be 2% off. So the net collection or net amount received by the seller will be $19,600. So they are actually a $400 off for the sales discount. For the gross methods, it assumes the customer do not take the discount. So we debit accounts receivable and credit sales revenue. For net methods, it assumes the customer will make the payment early. Within 10 days, all the sales discount will be taken. So it debit $19,600 accounts receivable, which is the amount after sales discount and the sales revenue. Then later, the customer makes this amount within 10 days. That means there are only 2% of 14,000. The total sales discount the customer has actually is 14 multiplied 2%, that's 280. This customer make two payments. One is the amount after sales discount, and the other $6,000 will be made later within 30 days. So for the gross methods, since it assumed there's no sales discount was taken, so in fact there was $280 sales discount. So the company will debit the actual cash amounts and the sales discount and credit accounts receivable. So sales discount actually reduce the amount of accounts receivable realized. The actual amount to be realized was $13,720. Since net methods has assumed the customer has taken all the 400 discount, it just debit cash and credit accounts receivable. No more sales discount in the follow-up transactions. When the next payment, $6,000 was paid, the gross method debit cash and credit accounts receivable. Well, the net methods will debit cash, credit accounts receivable, and credit sales discount forfeit. At the beginning, net methods assume there was $400 discount. Well, in fact, 120 was forfeit. So the actual discount was taken 280, which is same as the amount in the gross method. If we make this comparison, we find the net sales revenue is the same. Also, the amount of receivable has been realized is also the same, this amount. The difference is the assumption. Gross methods assume no sales discount was taken, while net methods assume all the sales discount was taken. Later, we only account for the amount forfeit. Both methods are allowed for accounting treatment, but net methods is more realistic. The reason is, although 2% is a small number, but actually it is a very generous offer to the customer. So here, this is a conversion. 2% for $100, 2% discount is 2% of 100. Actually, the customer pay $98. Or you can think the customer just invests $98 for the 2% return. And this is the rate of return is 2.04%. But remember, the company's offer is 210 net 30. Actually, the difference, the 20 days here, is the trade-off for the customers. You can either wait for 20 more days to defer the payments, or you just make the payment within 10 days. If the customer makes early payments, the customer saves $2 out of 100. And this saving is for 20 days. So if we annualize the return, it is a very large number. At this rate, 37%, no customer reject this offer. So the net methods is more realistic. Or for financial reporting purpose, net methods reflect real business activities. Here is a concept check. Which one is not true? No matter what methods, gross or net methods, it doesn't affect the net sales or cash receipts, total cash receipts. A, B, D are all correct.